In these sessions this morning, we're sort of further dividing up into more groups of greater specialization. So thanks very much to all of you for taking interest in the very interesting question of natural resource funds and some principles and some new research on how they can be managed in the public interest. I'm Patrick Heller, head of the legal and economic team at NRGI, and I was just assigned to be the moderator of this panel 10 minutes ago. Our two previous moderators had last-minute things come up and had to drop out. But that being said, I look at it as an honor and a privilege to be with you, and especially to be with this group of really distinguished and exciting panelists. As many of you know, natural resource funds are one of the tools that more and more countries throughout the world are thinking about and actually implementing as mechanisms for effective governance of revenues that come from natural resources. By our count, there are 54 natural resource funds currently in existence in the world, and it seems like every country that we work in, every day that we're in a new place, someone will say to us, hey, we're thinking about creating a fund. It is to say it's a fad is perhaps too dismissive of the real value that these funds have had in a lot of places, but there's also a reality that the lofty goals that are often ascribed to natural resource funds have not always delivered in reality. And I think what the discussion today is going to do is to start to illuminate or continue to illuminate something that I know those in the audience have been thinking about for some time, which is what are strategies that are more likely to make these mechanisms accomplish their goals and avoid some of the pitfalls that we've seen in places where natural resource funds become something that, far from promoting sound macroeconomic management and accountability, have often actually worked in the opposite direction. And so really excited about the discussion today and thinking through together how the world's thinking on what these funds can do and how to accomplish those goals can be carried out. To give a little bit of kind of where we're going on the panel, we have three panelists today. Havard Holland is going to begin by presenting some work that he and his colleagues have done at the World Bank with a focus on when natural resource funds invest domestically as opposed to just putting their assets into stable pools abroad. Following that, Sam Wills is gonna lead and initiate a discussion, and we hope it will be a real active discussion on some of the provocative themes that Havard has introduced in his presentation. Then Sam is going to do a presentation of his own on some of his own work around asset investment strategies and how his thinking and the world's thinking has evolved on that. Followed by David Manley, who will be presenting on some work that we've done at NRGI on natural resource fund governance and what the picture has been in the 22 natural resource funds that we've studied. So thank you very much for being here. Looking forward to an interesting discussion. And Havard, kick it off. Over to you. As Havard takes the stage, just to give a little bit of introduction, he's a natural resource economist at the World Bank who's been focusing obviously quite heavily on natural resource funds, but also works on resource-backed infrastructure finance, broader issues of revenue management and public financial management for the extractive sector. And Havard has a field background himself. Before being at the bank, he was a program manager in the DRC for the ICRC, and he's got a PhD from Cambridge. So welcome, Havard, and thank you very much.
Thanks for the introduction, and thanks for coming. Good to see some friendly faces. This paper came out of an observation related to what Paul Colliers and others have mentioned previously, that countries could invest a significant part of their revenues at home if they are capital scarce. Apparently nobody really had considered that they might want to invest through their sovereign wealth funds. And we started noticing that several sovereign wealth funds are doing this. Most economists would say this is entirely perverse. At least that's the impression we got when we put forth this paper. There was a debate: should we publish this? Well, now it's published, so I suppose I can also present it. We took the position that, well, this is happening. Sovereign wealth funds are investing domestically. So if that's so, it's probably not the best option in every situation. It's certainly not the best option in Norway, but we should probably look for ways to advise on how they should do it. And if there is an upside, we should look for it. Just a few numbers. Sovereign wealth fund holdings are total about 6.35 trillion at the moment. That might seem small compared to the overall institutional investor capital of 70-something billion, but still over 3 times of Africa's GDP. Much of this is from natural resources, minerals, petroleum. Some major funds mentioned here. Norway remains the biggest. Others are mentioned here, and there has been a 20% annual growth in the size of these funds. The number of these funds is increasing quite fast, actually. Many of the current resource producers are establishing new funds. The Nigerian Sovereign Investment Authority has started investing domestically. The Angolan is setting up. They are starting. Others are earlier in the process. These are, compared to Norway, China, they're relatively small, sort of 1 to 5 billion. But they do open up possibilities for investment, particularly in Africa, and raise some significant questions as to how they should be governed. So traditionally, of course, what we know, the way we know sovereign wealth funds is they are set up to invest abroad, to isolate the domestic economy from the fluctuations of oil prices, invest in liquid, high quality financial assets. Composition depends on to which extent they are meant to save, to which extent they're meant to be a stabilization fund. Degree of liquidity. Now, there has been a shift already in the traditional sovereign wealth funds. 56 funds, not percent of funds as it says here, 56 funds actually invest in infrastructure according to Preqin. But these funds invest in brownfield infrastructure, in safe markets, in Asia, in Europe. So it's not capital that is flowing into developing countries. They have a motivation for investment which is entirely commercial, portfolio optimizations. The funds that we'll be looking at today have an expressed intention to be, to some degree, a tool for development. That makes it problematic to manage them because they cannot longer be assessed purely on financial returns. So we have at least 14 existing sovereign wealth funds that include development objectives. Several established since 2005, so this is relatively recent. Several in the Gulf. We have some large ones in Malaysia, Kazakhstan as well. And there are these smaller funds which are coming up, or growing funds in Africa and as well as Colombia. Now these funds, as mentioned, they have development objectives which go entirely beyond the objectives that are traditional to sovereign wealth funds. Some examples here. For the Nigeria Infrastructure Fund, which is part of the Nigeria Sovereign Investment Authority, the objective is to invest in projects that contribute to the development of essential infrastructure in Nigeria. And similar examples for the other funds, Abu Dhabi to increasingly participate in and support the sustainable growth of the Abu Dhabi economy. So we are beyond the purely financial objectives. As an infrastructure investor, traditionally sovereign wealth funds should be no different. They have long investment horizons, so they are well suited to infrastructure. They would optimize their portfolio. That's what the current large funds do to the extent that they invest in infrastructure. Still not very large investments, but they are moving into this type of infrastructure. Now, if you go to a sovereign wealth fund that is investing domestically, the situation tends to be different. They are motivated by the infrastructure gap, by the limited access to international capital markets, underdeveloped domestic capital markets. And here, this is really the core. There is a conflict of interest because the fund owner, the government, is also the investment promoter. So how do you deal with this? This poses a set of very deep challenges to governance. So the traditional approach has been some version of the permanent income hypothesis to decide how much should be invested in the domestic economy. Some work on this has been done here in Oxford at Oxcar on front-loading investment instead of using the stricter version of the permanent income hypothesis. But mainly not necessarily specifying whether this should go through the budget or should it go through sovereign wealth funds. I think there has been an assumption that if it's domestic investment, it would go through the national budget. So if we move away from the permanent income hypothesis, how do we treat domestic infrastructure investments? If there is a high domestic return, then of course, there could be a high financial return, which would boost the return to the investment in purely financial terms and open more fiscal space. And there could be development effects that are far larger in terms of the payoff to essential infrastructure in power and in communication and so on. But this approach breaches the fiscal rule, so there is only the absorptive capacity to constrain spending. What are the risks for a sovereign wealth fund that invests domestically? What are we worried about? So clearly there are macroeconomic risks. If the fund is relatively large, is large relative to the domestic economy, and undertakes pro-cyclical investments, you may exacerbate macroeconomic volatility. And there is also the risk of inflating asset bubbles, and in times of high commodity prices, and Dutch disease. There could also be duplication with the national budget, and the fund could be used to bypass parliamentary scrutiny of spending through the budget. So in summary, the fund's domestic investment could undermine not only the quality of public spending, but also the wealth objectives of the sovereign wealth fund. Now, on accountability, on the investment side, the problem is that there is no natural mechanism for disciplining investments. There are no pension contributors, as you would have in a pension fund, to hold the fund to account. There are no taxpayers that the fund is accountable to if it's a resource, an oil fund and sovereign wealth fund. So essentially, when the funding comes from resource revenues, the sovereign wealth fund does not need to raise capital in financial markets. Even a domestic development bank needs to raise capital, so there is no constraint. In a way, the sovereign wealth fund has zero cost of capital. The capital is pumped out of the ground, and the fund is directly accountable only to the government. So this makes it vulnerable to political interference, elite capture, and there is a risk of white elephant projects that have often been implemented on the back of resource booms. So, could there be an upside? Why invest domestically through a sovereign wealth fund? We wanted to look at not only at the safeguards, but to look at the potential for a possible upside. So, let's say the fund is able to operate as an expert investor and maintain a wealth focus on its investments. Um, as mentioned, there's been considerable debate around this. Several of the people we have discussed this paper with argued that sovereign wealth funds should never invest at home. But again, it is happening. It is happening anyway, and other strategies are also not risk-free. Saving funds can be rated, so the traditional sovereign wealth funds with the investments held abroad in foreign currency denominated assets can be rated by a future less responsible government, and budget spending might also have little oversight. So possible investor roles. What are the type of roles that a sovereign wealth fund can take when investing domestically? It could share risk with private investors as an expert investor. These are things that we've been trying to focus on. What could the sovereign wealth fund do that could not be done through the budget? Sharing a risk with private investors, crowding in of private investment to projects that would not be bankable, or marginally not bankable. We'll get back to that, but they could have an important development impact. Could accept a somewhat lower return on marginally commercial projects with large social benefits. This is the risky part, and we'll get back to that a little bit later. And could thereby make the projects attractive for the private sector to co-invest in. And they could bring in external specialized capacity. So if they're co-investing with foreign private or publicly owned funds, the capacity that the partner funds would possess could also be brought into the investment process for the domestic investments. So what should we do? What are the safeguards? How can the risks be addressed? How can the integrity of a sovereign wealth fund's investment process be ensured, reducing opportunities for corruption and politicization while bringing additional expertise to the investment process?
5 minutes, Howard.
Thanks.
To answer those really important questions.
Yeah. At least 3 options are available. Firstly, domestic investment projects should compete for funding with foreign assets rather than be fixed at a certain portfolio share. This is not what most of the current funds are doing that are investing domestically. We feel this is really important. So in periods of low domestic returns or when indications of asset bubbles, when there are indications of asset bubbles, investment should be channeled abroad. If the investment project has a clearly defined development objective, if the investment project has a clearly defined development objective, it will still be benchmarked against the financial return on foreign assets, but you can have a limited markdown from the benchmark rate. So this would have to be set out in advance. How much could you accept? So that it could not be adjusted according to political circumstances. Investments that cannot be expected to yield a competitive return, such as, for example, public schools, would be undertaken through the national budget. Secondly, partnering with, as mentioned, partnering with experienced international investors can strengthen the integrity of the investment process and the quality of investments by bringing additional oversight and expertise. One example is the Nigeria Infrastructure Fund, which has signed a cooperation agreement with General Electric and also with the Africa Finance Corporation and with the IFC. Third, sovereign wealth fund governance structures must ensure that investment decisions will be made independently of political pressures. This refers to essential corporate governance features such as operational independence of fund management from the board, as well as an arm's length relationship between the board and the government as an owner of the sovereign wealth fund. And of course, we all agree that coordination with overall macroeconomic policy is needed to avoid exacerbating macroeconomic cycles. So coherence with investments funded through the budget needs to be ensured by coordinating with the overall national investment program. Now, what type of domestic investment should the sovereign wealth fund make? To answer this question, a fundamental distinction is that one between purely financial returns and wider economic and social returns. So just a quick recap of our understanding of these concepts. So economic returns here, as understood here, include externalities that might not be captured in the commercial justification for the investments. So if investments are made by purely on commercial criteria, potential productivity and growth enhancing investment may not be undertaken. So this is really the logic that is behind these funds that want to invest domestically and are doing so. So nevertheless, in the light of the risks, shouldn't sovereign wealth fund domestic investment be made purely on a commercial basis? Several existing funds do this. New Zealand's Superannuation Fund, Singapore's Temasek, they invest domestically, but on purely commercial principles. The problem in the developing countries that are setting up these new funds is that equity markets tend to be underdeveloped, and new infrastructure projects are frequently too risky to be bankable on purely commercial terms. So under such circumstances, the sovereign wealth fund's opportunities for domestic investment could be very limited, and the contribution to development could be marginal if the only terms used were purely financial returns. Implications, and I think this is my last slide. So what the proposed framework seeks to do is to define we seek to define a framework that uses a mix of market principles and policy-defined benchmarks to discipline the investment process. Investments that do not have some level of financial return should hence be undertaken entirely through the national budget. As mentioned, for instance, schools, health facilities, and only a narrow range of infrastructure is actually appropriate for sovereign wealth fund investors. The sovereign wealth fund should hence be limited to what we define as a commercial or quasi-commercial return, crowding in rather than crowding out private investors, and should invest only as a minority partner to limit the effects of political pressure. And of course, a clear and transparent process is needed to trade off financial against wider economic and social objectives. So now, the further challenges, this is the first paper in a wider research agenda. So what we will seek to define at the next stage is what can be considered an appropriate home bias. If you have a markdown from an international benchmark rate of return, what would that markdown be? We have some examples from development banks. Some use a return that exceeds inflation, and a return that exceeds government long-term borrowing costs, a specific target return. The IFC has a framework for this, which is called the Sustainability Program Quality Framework. In the meantime, the proposal we have is to use a target return for sovereign wealth fund's overall portfolio, combined with a threshold minimum rate of return for all investments. So this is what we're working on. We're doing a global survey on this and hope to develop this into something that is closer to a set of specific guidelines. Thank you.
Thank you very much, Havard. And what we're going to do now is Sam Wills is going to come to the stage and before getting into his own research is going to present some thoughts on Havard's work and the path that the World Bank has been taking on this issue. Sam Wills is a research fellow here at Oxford with a PhD in economics, also earned here, and has experience with World Bank, IMF, Bank of England, McKinsey, and others. So Sam, take it away.
Great. Okay, so first of all, I'd just like to say, fantastic, really interesting piece of work, and to be honest, I don't really disagree with very much of it at all. And so what I thought I'd do is just take this time to sort of extend it a little bit and push it in a couple of directions to make a couple more comments, things that you may like to incorporate, in the next draft. So the first thing I'd like to talk about is what type of funds are we talking about to begin with? And so in Harvard's paper and in the literature more generally, there's a discussion of 3 different types of funds. There's a fund that saves oil wealth for future generations. There's a second type of fund that manages the volatility of oil wealth. And then there's a third type of fund that manages absorption constraints, a temporary fund that you park some money abroad and then slowly drip feed it into the economy. And so I thought I'd make a couple of comments about the volatility fund, the second one of those funds, and what its relationship with domestic investment should be. The second thing I'd like to talk about is understanding exactly why this domestic investment isn't happening to begin with. And thirdly, I'll make a comment on where this investment should be directed. What types of industries within the country should be receiving it. Okay, so first of all, onto this second fund that I was talking about. What is a volatility fund? And in particular, how should we treat it? And so we've seen that, what you want to do is if you're exposed to this volatile income stream, you want to do a little bit of savings up front and build up a buffer stock of assets to sort of protect yourself against some of this volatility. But that raises the question, what should you actually do with that fund? And in particular, how quickly should you build it up? Secondly, should you dip into it when oil prices fall, or should you just leave it there? And thirdly, what do you do with it after all the oil has been pulled out of the ground and you're not really exposed to that oil price volatility anymore? So the first comment I'd like to make is on these volatility funds, the idea is that you want to prioritise them in the early years. And so here on this plot, the blue line is a future generations fund. So you're sort of borrowing before the windfall, saving during the windfall, and just consuming the interest earned on that fund afterwards. And then with the volatility fund, the green and the red lines, the idea is that you prioritise it in the early years, which may even mean saving something up front before the windfall even begins. And at the end of the windfall, you shouldn't consume it, okay? You don't just spend the volatility fund because you don't need it anymore. The idea is that you would combine it with the future generations fund and live off the interest earnings on it. Okay, so that's just an idea of what the volatility fund is and where it should come from. The second question is, what should you do with it? Okay, the idea of this slide is to give a comment on what happens if there's a negative oil price shock. And the punchline is that you're not meant to consume the capital of the volatility fund if the oil price falls. Rather, you just live off the dividends that it's generating. And the idea is because oil prices, basically you can't forecast them. They're very difficult to forecast. And so if the oil price is low today, your best guess is it's probably going to be low tomorrow and far into the future. And so if you start dipping into the fund in the hope that the oil prices will recover again, it's very, very quickly becomes an unstable sort of strategy. And so what that means is that if you're going to be thinking about this volatility fund as an additional source of income, then you should be taking a similar sort of investment strategy to a future generations fund. And that means investing in assets with a reasonably long investment profile, including, in fact, investing in assets domestically in developing countries. What types of investments should we... So, given that, what types of investments should these countries be thinking about? And I think there are a couple of questions you have to ask. And it's basically around why aren't these investments being done anyway? So the first question is, why? So you have a project that you're thinking about, should you be investing in it? The first question should be, well, does the private sector have access to that investment? And if it does, why isn't it doing anyway? Is there something that the private sector doesn't know that the government knows or the sovereign wealth fund knows better than them? Or is there something that the government can do that can reduce the risk of that project relative to the private sector? And if the answer is no to both those questions, then chances are you probably shouldn't be investing in it and it's not going to meet that hurdle rate of return. And the second one is, the question is if the private sector doesn't have access, maybe a better approach would be to give the private sector access, open up the capital account and encourage them to do it rather than letting the sovereign wealth fund jump in. And it's only if those conditions aren't met that the sovereign wealth fund should start doing it themselves. And it's important not just to focus on the return of the projects, but also realising that funds, both the sovereign wealth fund and private investors, have to think about the risk on it as well. Just because it's a higher return doesn't mean that it's a better investment. The final points are around what sectors should these funds invest in. And so if we split the economy up into 2 different types of sectors, the traded sector, which is things like manufacturing, which is exported, or the non-traded sector, which is things like education and services, well, the case is, there's a good case to be made that your investment should be focused more on supporting the non-traded sector rather than the traded sector. your initial intuition might be, well, you want to support the traded sector and get a diversified economy, pump money into sort of particular, superstars in the economy that you want to sort of build up a big diversified export base. But that doesn't really hold up when you put it into an economic model. What you want to do is to be meeting the demand that comes from this oil wealth for non-traded services. And you can meet that more effectively if you invest in the non-traded sector, you build up capital in that sector, which means that the price of that sector doesn't have to rise so much, wages don't have to rise so much, and it actually becomes easier for your export sectors to be able to support themselves. And so the idea is that what you would do is you would invest in the non-traded sector to sort of stabilise your real exchange rate, keeping an eye on how that real exchange rate develops. And if you find that you're getting a large real exchange rate appreciation, you should be pumping more money into investment in the non-traded sector. So there are a few of the comments, on that paper. But as I say, a fascinating piece of work, and I think, definitely worth pursuing.
Great.
Thanks.
Thanks very much, Sam. What we're going to do before turning to Sam's own work and to the work David will be presenting, we just want to open it up and have a few minutes of discussion on what Havard's presented and this approach that the bank is taking. Maybe before kicking it open to the floor for questions, I'll just ask a first question, which is a sort of practical one. Your presentation reflects a recognition by you and your colleagues that I guess what one would think of as the first best solution, limiting or restricting the funds from making these domestic assets investments is not realistic in a lot of cases. And I'm just interested from a sort of strategic approach when you're interacting with governments or the people you advise on these questions, how are you presenting these ideas or from what angle are you approaching them now? I mean, do you say you shouldn't invest, but here's what you do if you do, or kind of how have those discussions evolved over time? We're trying to think about the sort of practice of economic advising here.
Yeah, and as you say, the traditional advice has been to advise holding the assets abroad for several reasons that were mentioned. We're still at an early stage with this, so to the extent that we've advised governments on this, we're saying, well, we have been thinking a little bit about this, and these are the things that we have been thinking so far. Roughly the content of the paper. We don't claim to have all the answers. It's an ongoing agenda, but the funds are being established and have been established, and the standard advice from economists so far has been, don't do it, right? Invest everything abroad. There has been, as I mentioned, some activity here in Oxcar to say that more should be invested domestically, but I don't think, as far as I know, Oxcar has not said anything specifically on whether it should go through the sovereign wealth fund or through the budget, and so people tend to say, well, hold it abroad, and whatever you invest domestically, do it through the budget. And we're saying, well, since this is not happening, I mean, in spite of the advice of economists, well, then we should probably we should probably do a reality check and provide some advice that is useful for the purpose that governments are needing it for. Yeah.
Great. We'll open the floor to questions or comments. Was that a hand, Joe? Yeah. Okay. And again, a reminder to everyone: please introduce yourself. Joe, and then anyone else who wants to come after? Okay, Thomas, and then Belinda.
Joe Bell, YFLP. I mean, there is this kind of third solution, which is, in a sense, not official, where you say the fund itself should make no investment domestically, but it makes its transfers to the budget. And if they want to have a domestic entity engaged for creating domestic infrastructure, that should be a separate entity. Then you have better controls. Then you have better controls and distinctions between the two funds, because otherwise, then you're always up against how much is going back and forth. And so that if you keep a sharper line, but recognize it through the budget, or that they may fund an organization domestically, just as if we didn't have a natural resource fund, then you may have
not necessarily better control, but I think that's a hybrid alternative, and actually that's what in most situations I've been in we've recommended, to try to divorce those two functions.
Okay, rather than responding to each one, let's take these first three, and then I'll give both Havern and Sam a chance to weigh in. Please, Thomas, go ahead.
Thank you, Thomas Akabza from Ghana. I just wondering, what are the underlying reasons against investment of the funds domestically? In other words, assuming today Canada, USA, the UK, and Norway had set funds, would you suggest invested in Ghana rather than the UK here?
And then Belinda.
Hi, Belinda Richards from Allen & Overy. I just had one question, which is more a clarification, but when we talk about maximising the returns from these funds, it seems that we're just talking about dollar returns, so maximising financial returns, whereas the actual purpose of the funds was much broader than that in some of the ones you'd mentioned, and so perhaps coming up with some clarity and discipline. I mean, it's obviously much easier to have a financial number to hold people accountable, but if you're actually talking about a broader set of objectives, how one does that. And I think there might be some interesting things to look at in terms of the role of, for example, during city debt crises, the US pension funds and the role they've played in buying city bonds, with an idea that actually this creates more stability for the city and city employees who are the pensioners. So how one starts to look at that. And the second is just an observation around the crowding in point. And as a commercial lawyer, we act for a number of funds who are investing abroad, and a really key part of the strategy is to obtain knowledge and practical understanding as to how deals are structured, how they work, and building relationships with various private sector entities, be they financiers or the people who are actually the project sponsors, to be able to bring that home. So I think that's something that can be a very valid and beneficial objective, but again, quantifying can be the problem.
Ken, I was going to just take three, but you seem so eager. Please, I don't want to dampen the enthusiasm.
No worries. I'm Maria Masila. I'm from the Baronic School of Government here at Oxford. And my question concerns actually the upstream management and organization of funds for countries such as Sierra Leone or where they discovered new natural resources, but where they don't have the capacities yet and have also challenges into having transparency and managing those funds. Have the World Bank or international organization thought about some framework at the beginning of such a process where the country will have some assistance in managing, at least keeping the fund, in order for those not to be affected by the bad governance and ended up being not useful for the country. I was also thinking wondering if there has been any thought of linking this to kind of some aid programs at the same time to help those at the premises solidify the fund and help promote development without having leakages.
Great, thanks. And what I'd say on your questions is also stay tuned, because the presentations that are going to follow, and particularly some of the work that David will be talking about, will come to some of these bigger picture questions about governance of the funds. And so, I mean, you gentlemen are certainly welcome to answer that question, but also stay tuned, because I think a discussion of that is coming as well. So Havard will give you a chance to respond, and then Sam, and then we'll close the discussion for now and go into the next two presentations.
Thanks for your question, Joe. The way we have been thinking about this is there is only a narrow margin that is available for domestic investment by sovereign wealth funds. So it's pretty close to commercial, but there might be marginally non-commercial, non-bankable projects, such as let's say a power plant that is marginally non-bankable, and the sovereign wealth fund could take a slightly lower rate of return or a longer investment horizon. So the fund would be investing primarily on financial principles. And the one core principle here is if you have a fixed allocation to domestic investment, as you would if you allocate it through the budget, then you might be investing in projects that are not up to these standards. if you have a competition for funds between foreign allocations and domestic allocations, then according to very specific and predetermined rules, say a 1.5% markdown from the benchmark rate, for instance, then this is the type of safeguards that we believe could work. So if you use the budget, you assume a degree of flexibility that which a budget process might not have to allocate to the investment with an adequate return. So I suppose that's my answer. But I'd be happy to continue the discussion afterwards.
This wasn't one of the major reasons for finding separation is to try to keep politics on the domestic side of the line and keep professionalism on the other side of the line. Because so it isn't that you don't. Ideally, you don't end up making exactly the same sorts of decisions, but it's trying to say, well, all right, politicians, you're permitted to play over here, but you're not permitted to play over here. But since we have given you this right, you shouldn't be upset.
Yeah, no, we agree on the challenges, I think, and that is, of course, what we're trying to look for. A framework which limits the degree of political influence, for instance, by saying that the sovereign wealth fund, if it invests domestically, it should only be a minority investor. Second question: should the way I understood it, it was should established sovereign wealth funds such as Norway, for instance, invest domestically? Probably not. I think that would depend on the circumstance, but in Norway the budget process is considered, I think, to be relatively efficient, and maybe more importantly, it's a capital-rich country. So what you would be doing in Norway would be displacing private investment. Instead of crowding in private investment. So I don't see countries like capital-rich countries like Norway using a sovereign wealth fund for these purposes. For capital-poor countries, it might be a different situation. Third question.
I think the import of the question, that's why I said whether in Ghana, I use that for a purpose. You know, I think the underlying point, and my sister, they were talking about new countries that are suddenly seeing resource boom. One of the major decisions for probably favoring, investing these funds abroad has to do with some of the political risks that politicians could act with, a lot of indiscretion, and that when the funds are, available very local, at their reach. They will simply, the rate at which they can easily plunder those funds could be faster and easier than when the funds are invested outside. This was the angle that I don't know whether in your research you looked at the dimensions of the governance, the implications of the governance architecture in managing these funds.
And just to note, if you can certainly respond to that quickly, but then let's tie this up and move on to the next presentation.
Yeah, no, I fully agree, and the risk of political interference is kind of the reason we wrote this paper. That there is a very large risk, and we're trying to look for ways to mitigate that risk. But fully agree. Yes, the risk is very large if the fund chooses to invest domestically. Economic versus financial returns, question 3. It's quite a piece of work in the sense we're still working on this to figure out exactly how this should be done. As you mentioned, some American pension funds are doing this. They have some sort of home bias for their home state, but it's a very small allocation. It could be 2%, for instance, of their overall capital. But we are looking into American pension funds to see what they're doing. And I don't think there are no sort of foolproof ways of doing this at the moment. The IFC has its methodology, but it's not a quantitative methodology. It leaves some space for subjective assessment. So this is something we hope to be able to define a bit further as we progress. On the fourth question, which I understood was related to the availability of aid or support of some kind for policy on this issue. The World Bank and others, of course, do have specialists available. The World Bank Treasury Departments provides support for sovereign wealth funds on a regular basis. So the answer is yes. The support is around for countries that are interested. Yes.
Great. Well, thanks very much. Did you want to jump in on any of those points, or do you want to go to your?
It's up to you. Depends
If you have any burning points of view that you want to share, please do. We're interested in hearing them, and then we can jump to your own research.
Okay, sure. So I guess both on the second and the third question that we had, I think what's important to do is not to mix up the role of a sovereign wealth fund with the role of the government or its foreign agenda. There are structures in place, in terms of governments with their foreign policy, there are structures in place to keep politicians accountable to the populace. And if you were to divest that and give the sovereign wealth fund a major role in conducting a country's foreign agenda, then you're sort of divesting that to asset managers, and they're neither accountable nor necessarily experts in doing so. So I think it's important to sort of separate what the asset managers do, which is trying to maximise the rate of return. They're very good at it, but separate that from a country's foreign agenda or in fact evaluating social returns, which is what a government's job is.
Okay. Thank you very much. And now, Sam, the floor remains yours.
Okay, great. How long do I have?
Well, what we'll do is we'll give each of you and David 10 to 15 minutes, and I'll give you a kind of time warning to present. And then that'll basically take us to time, but since we started late, for those who want to stay, we'll keep going for 10 minutes into the lunch break for discussion.
Okay, great. So what I'm going to do for the next 10 minutes is present a piece of work by myself, by Ton van Bremmer, the handsome gentleman over here, who's doing a PhD in fluid dynamics, and Rick van der Ploeg, who's one of the directors of Oxcar. And what I'm going to talk to you about is the question of what sovereign wealth funds should invest in. So we've already seen something like this, but basically the reason why we should think about this is because sovereign wealth funds are big business. They account for about $6.4 trillion worth of assets, and so it's worth sort of directing our attention to what they are investing in. What's helpful to do is just drill down on one particular example to get a bit of a feel for what they may do. So what Norway does is it invests in a mix of bonds and equities, and that mix is given to the investment managers by the government. And what the government does is it says within the equities, your benchmark is going to be the FTSE All-Cap Index, which is a very diversified index of 7,500 different stocks. So it's basically the market portfolio. And the idea is that the investment managers will follow that index, and then the government sort of doesn't play around with it. But it has in the past changed the mix between equity and fixed income. And I'll come back to that in a second. The second thing that means is that the Norwegian government's allocation between different sectors is pretty stable over time. So if you look at that blue and the red lines here, they're the asset allocation in each different sector in 2009 and 2011, and you see that it just doesn't change very much. And secondly, you see that asset allocation has very little to do with the correlation of each of those sectors with the oil price, which is the red line going down. And so that sort of suggests that they're not really taking into account what the oil price is doing when they're choosing what sectors to invest in. And that's interesting because not only does Norway have this $800 billion worth of assets above the ground, but they've also got a similar sort of amount of money locked up underneath the ground in oil. So they've got a very large and volatile stock of oil underneath the ground. And in the past, they haven't given this any consideration when they're investing their assets above the ground. And so what Ton, Rick and I do is, for the first time, we think about how these assets above the ground should be coordinated with their assets below the ground. And a few things that we're going to talk about. First of all, what if you can't hedge those assets underneath the ground? How should that change your asset allocation above the ground? The second question, what if you can only invest in a limited class of assets? So at the moment, Norway is talking a lot about divesting its oil and gas stocks. They also have an environmental agenda. They don't invest in weapons and tobacco and this sort of thing. How does that going to change your asset allocation? The second question we're going to pick up is, when should those assets below the ground be converted into assets above the ground? And we get a few results there. And then the third result is going to be talking about how quickly should you be consuming the proceeds from that fund. And the first question you should ask is, well, hasn't this been considered before? It seems like a pretty obvious thing. Well, it turns out they've sort of touched on the idea before. They've considered getting rid of oil and gas from their portfolio, but they haven't really done it systematically. And what we're doing now is we're sort of rewriting the textbook and giving them what the economic theory suggests when they're thinking about these questions. And these are the punchlines. So the first punchline is around your asset allocation. And the idea here is that there's going to have two effects. Oil under the ground is going to have two effects on your assets above the ground. One is a leveraging up of all your assets, because your portfolio isn't just the stuff above the ground, it's also your stuff below the ground. And so you're thinking about your portfolio from a bigger perspective. The second thing is a hedging effect. And the idea here is that you want to offset some of that exposure to oil price risk in the assets that you invest in above the ground. So that means investing more in assets like airplane stocks and less in assets like oil and gas stocks. Because if the oil price goes up, airplane firms do less well, but if the oil price goes down, then returns on your airplane stocks will go up. The second set of punchlines around how quickly you should spend the assets in the fund. And what we see is that Norway at the moment spends a fixed proportion of its sovereign wealth fund. We're going to be suggesting you should be consuming a fixed share of your assets above the ground plus the assets below the ground, and use some precautionary savings to manage any residual volatility. And the third thing is a result on the rate of extraction. And the idea is, when you think about oil as a sort of a financial asset, then the idea is you want to be pulling it out of the ground faster than you would otherwise to generate a bit of a rate of return on it, to compensate you for the risk of holding it under the ground. And so I'll quickly jump through a quick recap of where the sovereign wealth funds are at the moment. Then I'll talk about portfolio allocation for a given level of oil extraction. And then, if I've got time, talk about what happens when you can choose your rate of oil extraction. Okay, so the first point I want to make is around, this is what happens in the absence of oil. Okay, so if you pick up a textbook by a bloke called Robert Merton, who got his Nobel Prize, I think it was last decade or the decade before, basically his punchlines were this, and this is what he got a Nobel Prize for. It's a simple equation, but there's a lot wrapped up in it. The idea here is that the amount that you hold in your sovereign wealth fund, which is the WI, has two parts. The red part, which is the size of there's the blue part, which is your optimal risky portfolio. And this doesn't depend on your preferences. The idea is that you just combine all the assets in the market based on their risk and their return, and you get a diversified portfolio, and that's the fund that you're going to be holding. And then the red part decides how much of that fund you want to hold, depending on how risk averse you are. Okay? The second punchline that comes out of this type of work is that you should consume a fixed share of the assets in your sovereign wealth fund every period. Consumption C is equal to a fixed share of your sovereign wealth fund F. And this is fantastic, because if you look at that simple piece of theory and what Norway does in practice, they match pretty much one for one. So what the theory says is your asset allocation should be divided into two steps. You should have a benchmark portfolio and then choose how much you hold of it. That's exactly what Norway does. They invest in the FTSE All Cap as their benchmark, and they choose how much of that All Cap index they hold, depending on how risk averse they are. And in 2009, when they decided they were willing to take on a bit more risk to generate higher returns, because this whole search for yield thing, what they did is they changed how much of that FTSE All Cap they hold, but they didn't play around with the assets within it. And the second punchline is that you should consume a fixed share of your sovereign wealth fund every period. And again, that's exactly what Norway does. Its spending rule is to consume 4% of the assets in the fund every period. And that sort of suggests that at the moment, the fund has been designed well along the sort of economic theory that we had 20 years ago when the fund was set up. but it ignores the elephant in the room, or the elephant in the ground, as we like to call it for the title of the paper, and that's the oil underneath it. Okay.
5 minutes, Sam.
No worries. So the first thing is you can get a handle on what the value of this oil underneath the ground is. Don't worry about the equation. Basically, all you need to know is that there are ways that you can, there are ways available to you to valuing oil underneath the ground that don't rely on good forecasts of the oil price. You just need to know its properties, how risky it is, how correlated it is with other assets. So that's possible. The second thing you can do is you can talk about the oil price in terms of how it's related to all the other assets in the market. And this is the way it's correlated with other assets. And so if you think of all these different shocks that are affecting all the different assets in the market in different ways, then you can sort of flip this around and think of the oil price, again, as sort of a different combination of all these different types of assets in the market. And that then allows you to sort of offset all that risk that's in the oil price by investing in different assets in different ways. And this is the punchline. So the idea is if you take oil into account, you're going to have this weight here, which is the red and the blue number, letter that we saw before. That's the amount of oil that you would have in the amount of assets you would have in your fund in the absence of oil. And now there are two effects. This just leverages it up by a fixed percentage, depending on how much oil you have underneath the ground as a share of the size of your fund. And that's offset by a hedging demand, which is sort of looking at how oil is correlated with the asset, and you want to hold less of assets that are positively correlated with oil. So you want to hold fewer oil and gas stocks, which is just like Norway is thinking about at the moment. And if I was talking to a room full of asset managers, what I'd say is that what you should be doing is rather than just using your FTSE All Cap index as your benchmark, you should be using a mixture of two indices. A market index, which is the FTSE All Cap index, and an oil hedging index. So this is an opportunity for someone from Morgan Stanley or FTSE or something like that to come up with an oil hedging index, which is completely possible, and then using that as a benchmark for these oil sovereign wealth funds. And this is just a bit of an illustration of what happens over time. So the idea is that if you just focus on this diagram here, this is an asset that is, this is your oil and gas stocks. This is an asset that's positively correlated with oil. And so the idea is you want to hold much less of it when there's a lot of oil beneath the ground, and you want to hold more of other assets that don't have any relationship with oil. And then over time, as oils pull out of the ground, you can hold more and more and more of this guy, and less and less and less of this guy. So the idea is that you're just offsetting what's underneath the ground, and so your asset allocation should change as the amount of oil under the ground changes. So the punchline is invest less in oil and gas stocks and invest more in businesses where oil is an important input, like airlines, transport, plastic manufacturing. The second punchline was around the consumption rule. So if you think about things from the bigger picture, you shouldn't just be consuming a fixed share of your sovereign wealth fund. Rather, you should be consuming a fixed share of total wealth. And that's just an illustration of that, but I don't really have time to go into it. Now, a natural question is, well, this is all very interesting, Sam, but what's the punchline? Is it big bickies? Is it small bickies? Is there any point in going through all this rigmarole of changing your asset allocation? What do we get out of it? And so what I've done is, taken a look at what the data says. So I've had a look at this FTSE All Cap index and its sectoral allocation. And if you do this properly, if you properly hedge away all your oil exposure, we're talking about something like an increase in the effect on your happiness, on your welfare, is equivalent to a 3 to 10% increase in the size of your oil dividend. So if Norway has $100,000 US for every man, woman and child, and they currently spend $4,000 every year, this is equivalent to having something like $4,100 to $4,400 for every man, woman and child in perpetuity. And to my eyes, that's a pretty big number. We also talk about what happens if you start restricting in Norway's asset space. So at the moment, they're talking about getting out of oil and gas stocks, getting more into green energy stocks, that sort of thing. I won't go into the detail now, but we think about this, and basically it changes your punchlines a little bit. And so if you're going to be divesting particular asset classes, you should take a broader perspective and think about how it's going to affect both your asset allocation and your spending rule. The final punchline is around extraction. The idea is that if you're treating this oil as a financial asset, there is an incentive to pull it out of the ground a little bit faster to generate a risk premium on your oil beneath the ground. Okay, very quickly, a few policy implications. What we've seen is that Norway's fund at the moment is designed well along economic theory. But that was theory before they started to think about what's going on underneath the ground. What Ton, Rick and I have done is we've updated that theory, rewritten the textbook in a sense, to show how they should think about it if they think about their assets above the ground and their assets below the ground at the same time. What we're trying to do is we're now interested in talking to funds to see their attitudes towards it. So far we've spoken to the Ministry of Finance in Norway. We've spoken to some representatives of the Saudi Arabian Monetary Authority and also the Abu Dhabi Investment Authority. And of course, if anyone else would like to chat about it as well, we'd love to hear both your comments and any other thoughts. This is part of an ongoing piece of work. And so the sort of directions that we're extending it are going to be considering what happens with the country's pension liabilities, which is often also an important consideration when investing in these sovereign wealth funds. And also the government's tax revenues, because Norway also has an industrial structure in the country. The government's tax revenues depend on what's going on in the salmon fishing industry and its other export industries. And so it's important to take those things into account as well. And so we're going to be building that into the theory. So that's pretty much it. I guess, I'd love to hear any thoughts, comments, or questions.
Thanks. So we're going to jump right into David Manley, who'll be presenting on a different element of this, which is the research that we've done at NRGI around natural resource fund governance, structure, and planning. Super quick word of introduction. David is an economic analyst at NRGI. He has been deeply invested in the drafting of the charter as well as the use of the charter as a benchmarking tool. He came to us after a period of time working with the government in Zambia and before that in private consulting. So David.
Thanks very much, Patrick. So just to set this into context, and I have 10 minutes, I'm going to be cutting quite a lot of my slides out. The last two presentations were on quite specific questions. One was, if you are going to invest domestically, what's the best way to do it? So second best approach. Well, Sam's was very much what sort of asset allocation should you have within particular fund objectives? And he was talking more about the Saudi Arabian and Norwegian type of funds. What the time I'm going to be presenting on takes a wider view, and mainly on the governance aspects of these funds. And just as a caveat, I'm not the author of this paper. This was Andrew Bauer from NRGI and Vale Columbia Center. So if I misrepresent the research, my apologies. So I'll skip over some things, but just on the scope of our study, we identified 54 natural resource funds with assets under management of about 3.5 trillion. That's about half as much as I think Havab was explaining. I think some of the definitions is due to we were looking at just natural resource funds and funds that had some sort of investment overseas rather than just domestic. But it'd be interesting to know where the big difference is. The breakdown of funds, a large minority was between the 1.1 billion and 50 billion, and quite a large number in the 1 billion or below. And most of them came from petroleum assets rather than minerals. We surveyed 22 of these funds in 18 national and subnational jurisdictions. So some of the subnational ones were in states of the US. And we looked at a variety of issues. And this is a bit of a product placement on the website, on the NRG website. You can see all the papers that were developed for this study and profiles on each of these 22 funds. And so this is just one of the pages of each of these profiles, which very neatly gives a scorecard of the governance of each of these funds. And these were developed as a combination of the Resource Governance Index standards, which were developed by NRGI, the Truman Sovereign Wealth Fund Scoreboard, and a Santiago Compliance Index. Other parts of the profiles were including stuff like summaries of the scores, the organisational structures of this, the rules and the institutional frameworks all in place. So each of these profiles gives a lot of material for researchers, for civil society activists and so on. So I encourage you to go on that. So that's the product placement part of it. What I'm going to do now is quickly go over some of the things that we've picked up from this initial research. So the first thing we found was, and I think this has been mentioned once already, there's been a massive proliferation of these funds. Since 2000, we identified 30 funds that have come into existence, and at least another 14 funds being considered by resource-rich countries or newly resource-rich countries. And I talk about this being the must-have thing for new producers, and if we have time, we can discuss that at the end. But we think there's maybe a danger that there's maybe an overselling of these funds. The funds have been adopting some rules, so governance has been getting better, but it's mainly been in the management structure and the operations, and less so in the more accountability parts of these funds, with disclosure and investment rules. So where to invest domestically, what sort of assets, and so on. Here are just some of the numbers to show you why governance is particularly important. All these numbers in billions. These are big numbers that are getting lost. The Russian government, for example, plundered nearly 10 billion from the National Wealth Fund that they have between 2009 and 2013. Kuwait Investment Fund lost 5 billion in the 1980s and 1990s investing in Spanish companies. And in Nigeria, tens of billions of dollars have been withdrawn from the excess crude accounts. So this highlights the importance of this, but what's worrying is that because of the poor transparency of the funds, we're only seeing half the problems. So we know about these numbers because the numbers leaked or have finally been disclosed, but half the funds are too opaque to study. So this is just showing there are some good examples. So I'm going to say it's quite, a lot of the things I'm going to say sound quite pessimistic, but there are some good examples. Chile, Norway, some Persian Gulf states, some of the US states funds seem to be good performers according to our study, according to the scorecard, but not necessarily all the states, and I'll highlight one in Alberta in Canada. What's made the difference between these two, our research has found, has been down to the rules, institutions, and broad-based consensus, the political tripod that Paul Collier often talks about, and I think talked about yesterday morning. So, recognizing that, what we try to do is to construct a process of going, well, how can you have a good governance fund? And we sketched out 6 steps in this process. The first one is to set a clear objective for the fund. What is the point of the fund? Why are you producing this in the first place? The second one is to establish some sort of fiscal rule aligned with these objectives. So the fiscal rule is as the revenues are coming in from the extractive companies, how much should be saved in the fund? How much should be spent in the budget? Where should these funds be allocated? The fiscal rule will also talk about when should these funds be withdrawn from the fund. The third one is establishing clear investment rules. So this is much about what was discussed in the last 2 presentations, and much of what Havel's been saying over if you are going to invest domestically, what's the best ways to do that to limit the governance risks.
5 minutes left.
Yeah. Fourth is clarifying institutional structures, rules and conduct. Fifth, to require disclosure and audits, transparency. I'll be coming back a few stories on each of these. And thirdly is to establish strong and independent oversight actors. So a fairly basic governance model, the good principles of governance. Now just to highlight some of the things we found in each of these. On setting the objectives, we found that it wasn't necessarily that these objectives were made clear. There was a number of governments where it was seen that they had established the fund, but they hadn't thought about why. It was almost like they'd just been sold this was the panacea to their resource governance problems, but they hadn't clearly identified, is this for a stabilization problem? Is this a long-term savings problem? Is this any of these things? Is it some sort of domestic investment? So Azerbaijan State Oil Fund, for example, had 3 objectives which were fairly loosely defined: to accumulate and preserve revenues for future generations, so the long-term objective; to finance major government projects, so that seems like a domestic objective; and to preserve macro stability by decreasing dependence on oil revenues. So, and none of these things were particularly defined. It's not necessarily a problem that there was those 3 objectives. I think we've said that you can have, say, a foreign objective of investing assets abroad and maybe a domestic objective. But without this clarity of what this meant, it was very hard for anything in the rest of the governance structure to be well directed. We also looked at whether these objectives were actually being met. And I think I've got this slide here. This just shows 2 funds in Chile and Venezuela whose objective was stabilization. So the blue line there is the government's revenues. So this is how much is coming in. So it's going up and down basically with commodity prices. And the red line is government expenditure. So for a stabilization fund, these 2 should be delinked. And that's what you pretty much get for the Chilean funds. You have a fairly straight red line, the general government expenditure, and then the up and down of the government revenues from the copper price. With Venezuela, on the other hand, it's very much in sync. So the stabilization fund was not performing its objective in this case. In our research, we sketch out a few more of these funds, and you can clearly see some of these were working, a lot of these weren't. On fiscal rules, how much time do I have? 2 minutes. What I'll do is skip to the last 2 things, which is really where Revenue Watch was major players in, and now RGI are. On transparency and oversight. We found that transparency was increasing in a number of these countries according to the scorecard that we developed. But as I said, still half of these disclosed very little. And there were generally opposition to many of the good governance principles and the Santiago principles, despite them signing up to these principles. And just an illustration of the costs of this, the Libyan Investment Authority during the Gaddafi era was investing billions of dollars in various quite risky ventures. One was given to Goldman Sachs to invest in equity and forex derivatives. They invested 1.2 billion, lost 1.18 billion. The chair who was originally going to be on this panel, Dr. Jahani, is now suing Goldman Sachs for this. And that would have been an interesting story, and I'm very, very sorry he's not here. But it shows the massive amounts of money that were being leaked out. And it's only very recently, after the Gaddafi period, that this stuff came to light. On the last thing, on establishing independent oversight bodies, and I'll be very quick on this. One thing we found that it's not enough to have internal auditing, auditors generals and internal accountability oversight actors. It was necessary to have much broader based support, so public support. And this is for 2 reasons, not just for the oversight reasons of people keeping in check. So we heard yesterday about the Ghanaian story, that there was a whistleblower, and I believe one of the journalists found out some how the fund in Ghana was not operating properly according to the rules. So that's the oversight mechanism that civil society and the public can hold. But we also saw that the public needed an understanding and appreciation of the fund, so that they weren't the cause of withdrawals and movements away from any fiscal rule. So they didn't support populist agendas and political agendas that were saying, okay, let's just spend this money, let's forget the fund. If there was a campaign to educate about the long-term value of the fund for the people, this seems to be a much better, more valuable role for the public. So I think I'll just end there. Thank you.
Great, thank you very much, David. And that research, as David says, is available on our website, but David and several of us are also around to answer any questions you may have. Let's I know we're reaching towards the lunch break, but let's kick it open for a few questions and comments, and the panelists can respond. If anyone has energy in the pre-lunch period. Yes? Well, for the webcast, so you can get started, but introduce yourself, please.
I'm Carlos Monge, the Latin America Regional Coordinator for the Natural Resource Governance Institute, NRGI. Would it be possible to include the funds in the EITI mechanism? I mean, we have a design, we have an institutional design to foster transparency in the extractive sector, and we have always been discussing about how to broaden its agenda or where else to take it to cover increasing ground. And I believe that this could be a response. I mean, in countries that have funds which are funded by monies coming from the extractive sector, well, your annual report should include the basic indicators regarding that fund, other than their own internal and external accounting and control and whatever mechanisms, but that could be like a quick move. But I don't think this was discussed in Sydney, but I think that we could open that agenda.
Great. Other questions or comments? No, lunch is looming. Okay. Any thoughts on the ITI question?
Well, I'm not an expert on the ITI, but I think on the new standard, there is now a section that is starting to chart revenue inflows and revenue outflows from sovereign wealth funds. So I think it's within there.
Yeah, and there's a general commitment in the new standard to report on revenue management policies and practices of the government, but it remains relatively vague. Okay. Well, let's go eat, but before we do so, let's thank our panelists for some really interesting and illuminating presentations.